Hey guys, welcome to Lunch Money Investing. This is episode 1. The purpose of this channel is to document a portfolio in M1 Finance that I created about a month ago with the sole purpose of investing my lunch money. So I work from home in the Bay Area as a software developer, and one day about a month ago I asked ChatGPT, I gave it some data and I asked roughly how much money am I saving every day? And the answer came out to about $36 between gas, food, wear and tear on the car, clothing, haircuts, right? You can see my hair, it's kind of messy right now. All that stuff factored in came out to around $36 a day. And so I decided, since I'm not spending that money, I should do something with it rather than just have it sit in my bank account or just waste it on random things. So I decided to create a M1 Finance portfolio with the stated goal of trying to get to $1 million as quickly as possible using my lunchtime money. Right. So obviously with anywhere from $15 to $35 a day, it's not going to grow there in a year, 2 years, or even 10 years, probably be like 15 years. But the purpose of this portfolio is to reach $1 million. And the purpose of this channel is to kind of just document that process over time. So hence the name Lunch Money Investing. Anyways, let's go ahead and get started. So this is my M1 Finance portfolio, which right now sits at $2,154, down around $120 for the week, or 5.5%. Now this account started with a little over $1,000 a month ago. And then when I decided to kind of go towards this goal, I added a little bit more just to kind of beef it up to try to get to 2,000 by basically the end of May. And then since then I've kind of tapered down, just putting in between $15 and $35 a day. But anyways, if we see here, I am down around $125 for the week, and I deposited around $124 for the week. So on an account balance basis, the portfolio is down around 50 cents. So nothing wild. But on a percentage basis or a money weighted basis, I am down around 5.5%. So obviously big moves. No one likes to see numbers like that, especially to the downside. But this is, only 1 week. And like I mentioned, this goal is something that I know is going to take well over a decade. So 1 week returns, 1 month returns, doesn't really matter. But we can go ahead and dive into the details here. You can see this portfolio is composed of 7 different slices, each named after kind of the asset class that it's trying to represent. So we have interest rates, which are bonds, equities, stocks, crypto, gold, US REITs, equity momentum, and systematic trend following. Interest rates, the biggest holding there is TLT, and we can see that was down around 0.5%. You do notice that there are REITs in here. These are going to actually get moved into the US REIT component. The original logic for having these in here is because these are rate sensitive, right? So when interest rates go up, bond prices will go down, REITs will go down, and when interest rates go down, bond prices, TLT, will go up and REITs will go up because obviously, they take out mortgages, they take out long-term debt. So the cheaper the debt, the better for the company. But anyways, we can see that is down around 0.5% overall. In terms of dividends earned, I earned around $2.50, and the portfolio lost around $6. So, those dividends help cushion the blow a little bit, not too much, but just enough. After that, we have equities, which is the largest targeted position at 35%. Bonds is at 30%. Equities, it looks like it's only 35%, but if you actually dig into the details, you'll notice I am exposing myself to more than 35% of equities using leverage ETFs. So I have SSO, which is a 2x S&P 500 ETF, and I also have UPRO, which is a 3x leverage ETF, and QLD, which is a 2x NASDAQ 100. So all these combined, give me a lot more exposure than just the 5, and 70%, because each one of these is either double or triple that notional exposure. You also notice I have QQI, which is a covered call ETF. So the reason I paired that with these leverage ETFs is because leverage ETFs do suffer for something what's called volatility decay. So when markets go sideways, these ETFs will actually underperform. So the S&P can go up 1 or 2% a day, then down 1 or 2% the next day, and over time end up being exactly flat. And these ETFs will actually be down maybe 3 to 5%, depending on the volatility during that sideways period. So the higher the volatility, these leverage ETFs will actually be more negatively impacted. However, in order to kind of offset that and try to monetize some of that volatility, try to harvest some of that volatility, I've incorporated some volatility selling ETFs such as QQQI. and these will actually benefit via higher payouts. And then I can take those payouts and buy some of these depressed ETFs. You also notice I do have some international exposure via VXUS. This will, in all likelihood, be sold over time. Once there is a sizable market correction, I will likely redeploy this 10% and split it between 5 and 5% on UPRO and QLT just to increase my beta exposure there. Because ultimately, equities, they are the largest growth engine, so I want to maximize my exposure to that position. And then we have crypto, the fun part. So crypto has gotten kicked in the face repeatedly this past week. A lot of it has to do with the selling of 32 Bitcoin by MicroStrategy. So they sold 32 Bitcoin earlier this week to pay dividends on some of the preferred shares or something like that. I'm not 100% sure about the details about what they're going to do with that cash, but they sold Bitcoin to basically fund a dividend. And that created some forced selling as prices went down. That triggered some margin calls on some leveraged Bitcoin positions, and that overall resulted in the very negative market performance that we saw this past week in Bitcoin, Ethereum, altcoins, what have you. They're all down. But right now, this is around 16% of my overall portfolio, and I'm actually seeking to increase this exposure. Bitcoin trading around 60,000. Not so long ago, it was at around 120,000. This is very early in this project life cycle, so this is actually a really good thing for me because I'm able to buy this highly volatile asset class at a discount, and this should hopefully turn into future returns once it stabilizes and turns around. So I'm actually expecting to increase my target allocation to cryptocurrency over the coming weeks and months. I would cap it around 20%. Right now it's at 16%. But if I see it go down to $50,000 a coin for Bitcoin, I would probably up that up to another 17 or 18%, and so on and so forth. So exciting stuff there. I do have gold, and gold is really split between two different ETFs. I have obviously the iShares Gold Trust ETF, which is backed by literal bars of gold sitting in a vault somewhere. And then I also have this NEOS High Income ETF, which again seeks to capitalize on volatility, but this time within the gold space. So when volatility in gold spikes, the premiums on the various covered calls of various durations, various strike prices, those go up, and that translates into more dollars for me to purchase more gold. And gold is a stabilizing asset class, especially over the last year and a half. We've really seen it shoot up as geopolitical uncertainty has increased, inflation risks have increased. Gold has performed spectacularly as a hedge in people's portfolios, so it's included in here as well, in mine. And then the last three here, rounding it off, they're not large exposures. I got 3% in US REITs, 1% in equity momentum, 1% in systematic trend following. These are small positions that I'm seeking to grow over time. The one that's probably the most interesting is the REITs position. If you are familiar with Vanguard and their ETF offerings, you might be familiar with VNQ, and then you might be asking yourself, why didn't I just purchase that? The reason being is VNQ, although I think it's a phenomenal product and it holds a large swath of US publicly traded REITs, it holds REITs that are both self-managed and externally managed or third-party managed. Historically, if you look at the track record, looking at the financial performance and the stock performance of self-managed REITs, they have historically outperformed third-party or externally managed REITs. And so for that reason, I figured I can do better than VNQ by strictly eliminating all externally managed ETFs. So all these all these REITs that you see here, these are all self-managed REITs. And they have over time produced better risk-adjusted returns than the third-party or externally managed REITs. And all I did is basically create my own market cap weighted ETF here. So I just did some research, found the largest publicly traded 21 top REITs, and then made a market cap weighting, and that's what you see here. So these funny numbers aren't picked at random. This is just reflecting the market cap weighting scheme here, and that's what we have there. So I have my own REIT. Kind of excited about that one, and that I'll just rebalance annually, so nothing crazy. And then, as I mentioned, I have two different momentum trend following style ETFs. So the equity momentum ETF, there's 4 different ETFs. Each exposing itself to the momentum factor within US stocks. So momentum, this is cross-sectional momentum. So this is looking at the performance of, let's say you're looking at the S&P 500, you're going to buy the top 100 over any given period of time, over the last 12 months, 6 months, what have you. And every quarter you'll rank them based on 6-month performance, and then you'll buy the top 100. That doesn't mean that the top 100 necessarily have positive momentum. They can all be going down over the last 6 months, but maybe they're going down less than everyone else, in which case they're exhibiting positive momentum. So these ETFs here, again, they just really aim to expose you to the momentum factor, which if you look at returns overall, they can be broken down into different component parts. They can be broken down by value, quality, size, momentum, obviously, volatility is another factor. And I'm just really a big fan of momentum. So I decided to kind of focus and double down on that particular factor and, buy these ETFs to kind of express that view. So they all have different flavors of how they implement their strategy, but they all end up doing more or less the same thing, which is buying stocks that are going up and holding them, and then avoiding stocks that are going down. And then, whoops, wrong way. The trend following component is composed of two different ETFs, and trend following and momentum often get confused, but momentum is cross-sectional, whereas trend following, at least within these two, it's time series momentum. So it's looking at an asset price today compared to that same asset price a year ago. And if the performance is positive, it has positive trend following attributes, positive momentum, in which case it would be more than likely long in these portfolios. And if the rate of change or the performance is negative, they would likely be short that asset class. So right now, I don't know for sure, but these two ETFs probably are long gold. For example, if you look at gold over the last year, it is up significantly. So they are probably long gold. And if you look at bonds like TLT, they are probably short bonds, just because TLT and other bonds like that are performing pretty bad over the last year. So, that's pretty much how they allocate their capital. And it's different than just a typical buy and hold approach with these. They buy things that are going up and sell things that are going down, and hopefully creating some alpha for investors. So that's really the goal of holding this one or both of those. Again, it's at 1%. This will actually grow over time too. I am shrinking my interest rate exposure and going to get this down to around 20%, and that would likely feed into REITs, equity momentum, and systematic trend following. Really, because I was thinking like, my goal is to get to $1 million as quickly as possible. Bonds don't necessarily help me in that. They do help me reduce volatility, but I'm not really too afraid of the volatility. So I just figured I should reduce interest rate exposure to 20% and maybe even eventually down to 0 over time, but we'll see. Anyways, thank you very much for tuning in. Please check in often. I aim to post around once a week and provide updates based on what my portfolio is doing, what the market's doing, and hopefully that's entertaining, inspirational, motivating. And if you like it, give it a thumbs up and definitely subscribe. See ya.